Buying property today looks very different to how it did 10 years ago and even 5 years ago. With sustained price growth and ongoing supply shortages across Australia, the way people enter and navigate the market has fundamentally changed. Preparation takes longer, competition is stronger, and availability is the biggest challenge. Success today isn't about finding the best deal, it's about building a position of strength even before the right property appears. That's where full-service property agencies come in. Momentum Wealth was Perth's original full-service buyers agency, and we're celebrating 20 years this year, and that's 20 years of knowledge, experience and relationships we have to share with the thousands of clients we've helped on their investment journeys. Today's episode was inspired by questions from listeners looking for guidance on how to navigate the current market, from standing out as a buyer to choosing the right team. And to help unpack this, I've brought in some of the team from Momentum Wealth. We'll walk through the experience of a real client case study that's worked with all our business units and built impressive wealth through property. To kick things off, I'm joined by Caylum Merrick. He's the Manager of Property Strategy and Finance at Momentum Wealth. Caylum, welcome to the show.
Thanks, Damian. Good to be here.
I want to talk today about a client and their process through the Momentum Wealth journey and how we help them build a property portfolio. So tell us a little bit about the client's background.
These clients were living and working in the US at the time. They reached out to us early 2023 and they, in mid-50s, now in terms of what they were looking to achieve, and this is where we start with every client, is we want to understand what their long-term goals are and what it is they're looking to achieve. I mean, we all want to make money in property, but other than that, what other specific considerations were there? So for these guys, they had a 10-year investing horizon that they were looking to go through, and they were also had the requirement of wanting to relocate back to Perth because that's where they were originally from. Family were here, so we had to build all of those considerations into the actual plan and strategy. So first it started with looking at their current position, making sure we understood the capacity, their risk appetite, all of that kind of stuff, and then so for these guys, they had properties located in Queensland, so they weren't first-time property investors. So for us, we wanted to understand those properties, what was going to happen in terms of their future growth. Would it help or hinder, in terms of what they were looking to achieve? So we sent that to our research team. They had a look at it and identified that based on those properties, they were all located in separate regional mining towns in Queensland, so high risk, a bit of volatility there. We thought it was best to offload those. So with that, when you're looking to sell a property, there's obviously going to be some capital gains tax considerations. So at that point, we wanted to make an introduction to an external advisor. So that introduction was made, and it meant that based on where they were living at the time in the US, it wasn't worth selling them straight away. So we had to kind of factor that into the plan and look to incorporate it at some point down the track. So at that time, and you'll be well aware of this, Perth had been going very well, and we obviously were still quite bullish on its trajectory and what was still to come. So we wanted to get these clients into the market as quickly as possible, and we thought it was a great opportunity given the fact that they were looking to relocate to buy what was going to be a future principal place of residence. And so we got the buyers agency team involved, looked at the acquisition strategy. We wanted it to have good investment fundamentals because it was going to continue to be a bit of a platform for them to build off in terms of the overall portfolio, but also met the needs in terms of location, close to family and the likes.
So let's just back up there. So tell us about how do you figure out the risk profile of a client and what's suitable for them?
Yeah, so we ask a lot of questions around how much debt they're comfortable with, whether they're looking at more so capital growth or more yield focused cash flow, their thoughts on debt, as I mentioned, and things like value add projects. Are they willing to take on a development? Are they completely averse to that? So that sort of stuff, understanding that. The other side of it as well is the financial capacity. So you might be, all gung-ho towards taking on a development, but if you don't have the capital and the cash flow to be able to get that project through to completion and activate it at a time that makes sense, then that it doesn't necessarily align. So it's a good conversation up front, and a lot of conversations are had with these clients to get a sound understanding of their appetite, risk profile.
Do you find that people come in with an idea on the property they're going to buy, and then when you go through that process of understanding them and their risk profile, that things change?
Absolutely, yeah. I think a lot of promotional content out there of what makes a good investment property isn't always necessarily aligned to every person. So that's why we don't even think about the style and type of property until we get to know the clients and figure out that risk profile. So yeah, we've seen a lot of people on both sides of the fence be a bit more, I guess, risk averse and conservative, but based on the conversations we've had and open them up to the potential opportunities and showing them the numbers, they've actually taken a more aggressive approach.
And even though they were in their 50s, based on their circumstances, again, that's not everyone's different, aren't they? They were still willing to go aggressively, even though they were old like me and into their 50s.
Yeah, look, they were. I guess the time horizon, 10 years is a long time, but in the scope of property and long-term hold and looking to really get the benefits of compound capital growth, it's not that long. So there was some specific intention around what we were looking to do. We knew that we needed to act quickly so that we could get the time of those assets sitting within the portfolio and allow that growth to happen. So just on that though, these clients as well, they didn't want too much of a debt position. So they had capacity to borrow more, but it was important for them to, I guess, try and limit that as much as possible because they were on decent incomes at the time, but with the relocation back to Perth, those were going to drop. And they didn't want to have to be, constantly worrying about meeting mortgage repayments and the likes. So part of building into that strategy was not just going for top of the range properties at huge price points. We wanted to let the cash work a bit harder for them and not over leverage the position. So decent enough purchase price points, but not to a point where they're having to borrow, extensive amounts of money to make it happen.
Yeah, and that's certainly the goal of all investors is generally to get to retirement when they're winding down and don't have an income from their job, that they can live off their investment properties. And that may mean, look, we don't know, no one can tell what's going to happen in 10 years, but that may mean that they get to that stage that all the debt's either paid or if not, they might have to sell one or two of their, hopefully 5 or 6 properties, and they're in a position where they can still then be debt free.
Yeah. Exactly. And I guess further to that, for these clients as well, given the fact that they were cash flow conscious, we introduced the early conversations around Westbridge Funds Management, our sister company, to look at diversifying the portfolio right from the get-go so they could balance a bit of capital growth with yield. So the resi was to take care of targeting that aggressive capital growth, and the Westbridge side and the investing they did there was to help balance out the cash flow of the portfolio.
And how'd you go with finance for, the finance market's always changing, bank policies and so forth, but how did you go with an offshore, even though I assume they were Australian citizens, but how did you go with an offshore client and borrowing back into Australia?
Yeah, there were definitely challenges, not all. It just meant that we had to, first of all, figure out the lenders that were open to lending to that sort of situation. There's still plenty of options available, but yeah, each lender treats it differently. Given the fact that, fortunately, WA is still working on paper-based mortgages, you've got to factor those considerations into it as well. So sending a physical document overseas and getting it back in time to meet your settlement deadlines and the likes. But our mortgage broking team are excellent. They understand the complexity, especially for clients based overseas, and we're able to identify some good lending options for them while they were over in the US.
And is there, so basically they could still get loans,
Yep.
not easily, but choosing the right lenders and going through that process, they were still able to have a few options at least.
Yeah, definitely. And it's just about understanding the landscape up front. You don't want to be submitting applications to a lender that won't accept your income. So that's what a mortgage broker does. A good mortgage broker will understand the lending landscape, understand which lenders have appetite for certain incomes, and also making sure that they'll accept enough of the income, because they'll shade it to a degree based on the currency fluctuations, but making sure there's enough serviceability in there to meet the debt requirements.
So there'd be a lot of people listening who aren't necessarily from overseas, but they've got some quirk to their financial situation. They get a lot of bonuses, or they get less salary. They get, maybe they're self-employed and the income's volatile. How does that generally work if you want to borrow? When you go, what's below 80%? I guess is different then to when you get into that mortgage insurance territory, is it?
Yeah, definitely. The lenders are looking at two core pillars, I guess. It's your servicing position, so the income, how you're going to pay off the debt and take into account your liabilities. The other side of it is the equity position. So how much risk are they taking? Are they lending quite close to the overall value of the property? But I guess even across the major banks, they're gonna have different policies to one another. So if you approach all of the banks and present the same scenario, you'll probably find that they're all going to lend slightly different amounts to you. And in some cases, some lenders, you'll pass servicing and can get the loan easy. Others, it's a no. So that's why it's important to understand that you need to align yourself with a broker that knows the policies, and they're forever changing as well. So understanding, because at the end of the day, I think what a lot of property investors do find is that they get tapped out with serviceability before anything else. They might have decent equity, but they can't borrow enough funds out of the portfolio to continue investing.
So Caylum, once you knew what the clients could do and what they were comfortable doing, how did you engage with the buyer's agency team?
Yeah, so we have the pre-approvals in place. We're finance ready, so that's when the introduction's made to the buyer's agency team, and we give them all the information on the strategy. We tell them about the investor profile, what style of property we're looking to target, and then they go out and execute the search. And once they've found a property, it's then about engaging the property management team, especially for that first acquisition. The clients, being a principal place of residence, it wasn't going to be the home they'd live in immediately, so we did need to rent it out for the short period at the beginning. So there was a few cosmetic renovations that we were undertaking just to maximise that yield while it was an investment, and the property management team handle all of that. So clients aren't even in the country, and we're able to basically identify the property, get it acquired, and get it market ready, and get a tenant in there and generate income.
Because of course you're working with that client all through the process, and as the finance team and with the buyer's agent. So how did the client feel? Did they feel it made it easier to have one team do everything for them?
Absolutely. I think that's what a lot of people who experience working with us, when we ask them how they found the experience, it's some of the top comments are around the fact that they didn't have to worry about anything. Having your buyer's agent working and sitting next to your mortgage broking team, I mean, that's how we win properties in a very competitive market. When we're looking about how short can we make this finance clause to beat the rest of the offers going on out there. If you've got, your buyer's agent sort of in a separate office, not even communicating with your broker, that's when you miss out on properties.
And from all that work you did with the finance team and the strategy team, where did they come up with in terms of how many properties they were going to target in the short term, and did they have any longer term or medium to longer term goals?
Yeah, it was about understanding. It was a bit of a balance between the client's risk tolerance and profile. They did have some specific numbers they were looking to achieve, even though they hadn't really thought too much about it. The target number at the beginning of the strategy was, when all is said and done, once they've got their assets, they wanted them to generate about 100K per annum in passive income. So we established that based on the debt levels they were comfortable with and the capacity as well, that a total of 4 properties all up, so the principal place of residence and another 3 investment properties, and the decision on how we acquired those properties and the entities and the structures that were set up, that was taken into consideration as well. So getting involved those external advisors who we work closely with, because there's tax considerations, all of that stuff that you need to make sure is complementing the acquisition strategy of it. So they ended up with 4 properties in the resi space, and they did some more investing, like I said, with the Westbridge side. So they've far exceeded their original expectations already. And they've still got plenty of years left for the portfolio to continue growing. And
just want to explain the importance of working with that external advisor. Obviously, we know some great accountants and financial planners, but just how important that was that you sent them to get the advice. Obviously, the client's got to do, technically should do that themselves, but we're there to help. How did you just tell me that process and how important that became in their overall strategy?
Yeah, it's critical because I guess before we even really put pen to paper, we sought the advice from the accountant first and foremost. When you're looking to sell some existing properties and roll some of that capital and free up cash flow into a better market, there's other considerations than just what's the growth and what we're going to achieve. So there was some back and forth in the early days, and even when they relocated back, we got together with the accountant and the financial planner and basically undertook a bit of a plan to allocate the funds the clients had to specific avenues. So a self-managed super fund was part of the whole journey as well, which they bought a property in that, and they also continued investing, because speaking a bit off the topic of property at the moment, I mean, we're always all for diversification as well, and the clients obviously working for so long over in the US didn't really have much established by way of super. So we wanted to allocate capital smartly, and we understand that it's not just has to all go into property. It's got to be a balanced approach. So we work very well with those external advisors and set the clients up for, like I said, already great results, which we'll talk about in a bit. But yeah, it's definitely important to get that done early rather than try and seek the advice after you've already made a few acquisitions and found that you've done it in the wrong entity or the likes.
Great advice, Caylum, and great way to kick off the show. Thanks for being here.
No worries. Thank you, Damian.
The next stage of the client's journey, of course, was buying the properties. And today I'm joined by Luke Jones. He's a buyer's agent at Momentum Wealth. Welcome to the show, Luke.
Thank you, Damian. Appreciate it.
Before we get into the client purchases that you're involved with, some people out there have heard of them, but still some people who maybe don't quite understand what a buyer's agent does. First of all, I gather you get a brief from the finance and strategy team as to what the client's looking for and how much they can afford to pay for a property. And then what's the next stage? How do you there's even in the shortage market, which is a lot around Australia at the moment, where we've got a shortage of stock. How do you then narrow that field down from even the 1,000 or 2,000 or 3,000 new ones that come on each week to something that might be suitable for them?
Yeah, it all depends on the client's risk appetite and that strategy that we mentioned. So we identify high growth areas as a company. We've got a lot of tools and systems that we use to identify those areas. And out of Perth, gosh, there's 300 plus suburbs, and we're probably only buying in a third or less in those areas. So identifying areas that are great for owner-occupiers, not too many investors in the area, not too many rentals, a lot of factors.
Yeah. So we'll get into how we acquire properties off market in a little while, but I want to start with on market. So whether it's Perth, Melbourne, or wherever else, we narrow down those suburbs, and it's not a lot of suburbs we're buying in. We filter out to the best suburbs we think for the best returns over the long term. But then once you've got down to those suburbs, you've got the client's brief, you know how much they can afford, the yields that they're really looking for. How do you then narrow down from the thousands of properties that still might be available in that space, and even if it's hundreds, how do you then narrow down to the top 5 or 6 that's worth looking at for them?
Yeah, so there's a lot of factors. We want to narrow it down to areas that are within good proximity to schooling, transport, or school zones if that's possible, and education facilities, leisure, potentially restaurants and cafes, good commercial strips as well, shopping centres. So we want to try focus on the areas where people really want to live within those major cities.
So it's not just the suburb. You're not just going in a suburb. In some parts of some suburbs, it's actually specific areas, isn't it? You're narrowing it down to pockets of that suburb.
Absolutely. We try as best we can to narrow it down to the best pockets within that suburb, whether that be areas closer to high transport roads, or ideally not opposite a school, and areas with low amounts of state housing if there's any of high density of those around. So we'll go into the back-end tools that we've got, which can show us previous sales history, previous images that they've used, which gives us a really good idea of if there's any red flags to do with the property before inspecting, and that will really help us narrow down what assets to go view on the weekend so that we're not wasting any time. As you know, the market is rising and rising, so it's very important to pick the right asset early.
Let's talk about this specific client, and they've bought 4 properties through us.
Yes.
So do you want to just kick us off with the first one we helped them acquire? But just tell us a bit about that property and why it suited their particular strategy.
Yeah, so the first one was in an area within 30 kilometres of a major city, and that purchase, they needed to get their toes into the market. So we didn't want to buy anything that was too bullish of a play in terms of adding value. We wanted to make sure that the property was in rentable condition. We wanted to make sure it's in a family-oriented area, and that's what we found. We found a 4x2 asset. It was on a periodical lease, and the tenants were happy to stay on. And eventually the clients came to Australia and moved into that property. So it suited them perfectly, and the yield was comfortable as well. And it was a really affordable entry price for them to dip their toes into the market and have a bit of faith and trust in the company first.
And I think it's important to mention there, even if you've got a pretty aggressive strategy to buy lots of properties, what you don't want to do is see a client, go aggressively into something that's development potential, and if they haven't invested in a particular market before, and then it all blows up, and it's not the ideal outcome. So it's important, if you've got a bigger strategy, that you don't necessarily have to be aggressive on your first property, do you?
Absolutely, no, you don't need to be too aggressive. And for these clients, the area suited well for a long-term hold, and finding a family home that's going to get a great rental amount in a stock where there's not many rentals available was the perfect scenario.
So tell me about the second property. Tell me a little bit about that one.
The second home, we were a lot more eager to add value to that home. The clients were comfortable with us as a company. They knew that our residential asset manager could handle renovation works for them on their behalf and maintenance items prior to getting that property leased. So we targeted an asset. We actually found this one off market through an agent that we know very well, and they enjoy dealing with us because they like the fact that we're buyers agents that have clients ready, they're pre-approved, and they know that we understand the contracts and the terms. So we managed to get a property north of the first one, so a little bit of a different area. Again, within this one was about 20 kilometres of the city, and that property needed floors, paint, a little bit of roof maintenance, gutters, carpets in the bedrooms, and a little bit of a yard cleanup as well, and some cleaning around the house. So that property we purchased, we settled on it, and our residential asset manager got started straight away with those. And then within, I believe, a month and a half to 2 months, we got that rented out.
So the property management team at Momentum Wealth was able to take care of all those value add items, were they?
Absolutely, yeah. They organised trades that we know and trust and use all the time, and they, smashed it. They got it done very quickly.
Now let's focus on off-market. That was an off-market purchase, and I understand that Momentum Wealth, more than half their purchases are generally off-market. So people go, well, why would an agent sell off-market, and why do you get access to those opportunities that maybe the regular person doesn't get access to?
There's a lot of reasons why, and it really depends on the seller as well as the agent, but majority of the time it's the seller's circumstance. So this seller didn't want to advertise the property. They didn't want anyone through the house. But other scenarios, it could mean a long rent back for the seller. They might request that, and the agent doesn't want to go to the market. Sometimes it's a genuine off-market where they're only willing to sell off-market, and typically there's not many other people that find out except for us, or potentially a few buyers agents in the space that know the agent as well. So a lot less competition a lot of the time, and also we can write the contracts a bit more aggressively as well because of that.
Yeah, I think it's that flexibility, particularly for investors. If you're an agent, as a selling agent, and you've got a property that's got 12-month lease on it, we pretty much wiped out 75% of your buyers who are owner-occupiers. So that flexibility and being able to do seller leasebacks in a hot market, a lot of people are scared of selling because they might not find something else. If you offer people 3-6 months leaseback, that gives them more comfort to sell, doesn't it?
Yeah, absolutely. It's a great scenario for everyone. It's a win-win, really.
So let's get on to the third property. Tell me about that one.
The third one was a property that we purchased. It was off the back of that previous one. It was also off market, again, through an agent that we know that we bought off multiple times. The property had development potential. So this one had a split zoning in a local council area that we knew the split zoning was possible to work around. The house was already rented to a long-term tenant. It needed a bit of maintenance work, which the team got done after settlement, and we managed to renegotiate the lease to a higher rental amount, which was perfect, and the tenant was happy to stay on. So I believe it went from 700 to 780 really quickly, and the clients were very happy with the yield from there. And also the growth was very quick on this one because of that development potential. The fourth one was the most recent purchase towards 2025, in the start of 2025, and that property was a bit more comfortable for the buyers and the clients because they grew up near the area, so they felt a little bit more at home. It could be potentially one of the ones that they want to move into in the future, but for now that one actually was on market. We had to compete with multiple offers. It was a 3x1 with a nice workshop that potentially you could convert into a granny flat one day, so it was more of a full block potential with an additional 2x1 that you might be able to work around.
So what was the journey of that? The client, was it 4 properties over about a 2-year period, was it?
4 properties over 2.5 years, and they've just tracked 1.3 million plus in capital growth off those 4.
Yeah, I imagine they're pretty happy with that.
Absolutely.
I would be too. I would be definitely happy with that.
So
so thanks, Luke. That was great. And just then, where did they get to then after that? They got to the 4th property, but then I think they started looking at commercial opportunities, did they?
Yeah, they did. They looked at commercial opportunities with Westbridge because they were after a little bit more of a passive yield play. They've been pretty hands-on with these 4 over the last 2.5 years, and we connected them to Brad, who you'll see in a second, and it went seamlessly.
Brad's going to be next on the show, so thanks for that segue, Luke, and really appreciate your insight and advice and telling us that client story today.
Thanks for having me, Damian. Appreciate it.
And next in the hot seat, I've got Brad Dunn. He's the manager of key relationships at Westbridge Funds Management. Welcome to the show, Brad.
Thank you very much, Damian. Glad to be back.
And we're going to be talking about commercial funds and commercial property investments. But I want to start with your involvement on this client journey. So the client's got 4 residential properties. They sold a few that weren't suitable to their needs anymore. They had a 10-year strategy to retire and live off the income ideally from those investments. So tell me, at what stage of the journey did you get involved with the client?
Pretty early on, actually. It was really nice to come in with a very clear plan, a very clear goal of 10 years to retire. And of course, you can't retire without income. So of course, commercial property was going to play a big part within that. Now, they were obviously trying to find a house. They also had those 3 residential properties. The great thing about the residential piece of that overall plan is, well, as we heard from Luke before, you had a 1.3 mil uplift in, several years, and you've still got 8 more years to go left on the plan. So the capital side was doing fantastically. What they really needed was that balancing act. So all of a sudden we're saying, all right, well, on the commercial fund side, let's look at stuff that's going to generate that income for you. I'm sure you know better than anyone else, when it comes to residential property, it's fantastic for growth, but not so great when it comes to income. I think you're saying off camera, what is it, 2 to 3% net yield? So if you've got, say, $1 million in residential property under your belt, you're only expecting to get $20,000 to $30,000 a year in income out of that. And that's just not going to allow someone to retire. So that's where the commercial funds came in. If we could balance that out and start to provide them with, in the end, what we did was 3 to 4 multiple commercial funds, big diversified properties all around Australia, generating 6 to 7% yield plus capital growth. So all of a sudden, that same $1 million that they put into the other side of it, now they're getting $70,000 a year. And of course, they just compound and compound and compound. So all of a sudden, you're now building towards that goal of being able to protect your capital, get a generational sort of income that starts keeping through. You're not eating into your capital. In fact, you're still growing it, but you can now go out, enjoy your lifestyle, play your golf, babysit the grandkids, do whatever it is you do when you actually retire.
And that's an important point, isn't it? And that's our philosophy in the group, is that residential is a great place to start, and you can build your wealth on that journey through capital growth. But the income, well, even if you've got all the debt paid off, the income's 2 to 3% net, depending on where we are in the cycle. Commercial funds and commercial property can generate 6 to 7% And so it also, we'll talk about diversification in a second, but that balance is what we like to target. And ultimately, look, clients, we don't give advice on their commercial property fund investments. They have to make their own decisions, but we obviously can show them the opportunities that we have. But that balance, so if you've got, so let's say 3% in residential, 6% in commercial, 50-50, you're going to net 4.5%, and that's a lot better than 2 to 3. And as you mentioned, ideally, no guarantees, of course, but you'll continue to get capital growth at least the rate of inflation. Your income, ideally, no guarantees, will grow at the rate of inflation, and you're hopefully set for life.
Oh, 100%. And I guess the other piece of it as well is it may sound like a lot, but if you've grown that amount in your residential property, when it does come time to retire, well, you can start to wind down some of those assets and start to convert it over. So that 4.5% blended yield can start to get to your 5s and your 6s and your 7s. So, you know, these investors were quite passive. They didn't want any risk. They didn't want to worry. So we didn't put them into anything that was outrageous. It was just a good, steady income, good core quality assets all around Australia, big tenants, long leases. The whole idea was just to balance that income out with that capital growth, to give them that time so that when they come back to Perth and they live in their house and they're ready to retire, they're just set for life and they don't have to worry about income ever again.
So those clients obviously made the decision on their own to invest in commercial property. And why did they like funds in particular versus buying a direct commercial property?
Well, just the same reason that they decided to get a buyer's agent and a finance broker and a property manager to look after everything for them. They're busy people. They still have busy careers. They didn't have time to be messing around with commercial properties and taking risks in terms of trying to find tenants and manage those tenants themselves. They just wanted to set and forget, get a regular monthly income that comes through, and then they don't have to worry about it.
And the good thing, I guess, with funds is the ability to diversify. And we unfortunately can't seem to do that in residential because of the costs involved. We haven't really seen any successful residential funds with multi-assets. But in commercial, that's quite common, isn't it? Where you can have a fund that has multiple assets, multiple tenants, and not only that, you can spread your investments across multiple funds. So give you a very broad range of assets and tenants. Not risk-free, but diversification does reduce that risk, doesn't it?
Oh, it definitely. So they did it in two parts. So obviously each time we would get another opportunity come up, they'd be looking at the amount of assets that were sitting in that fund, the return, also the end piece to it. So it was always about what's that long-term plan? How does that align with my goals? Is it a long-term plan that's going to increase income over time? Is it going to finish in a certain year, which means I'm going to get capital back at that year and not another year? So they started to really think ahead and map out couple of hundred here, couple hundred there, couple hundred there. And when you look at it, all of a sudden, they're gone across 40 or 50 different commercial properties, all core locations, all around Australia. So when you talk about reducing risk, whilst there is also still risk within any sort of investment, you do de-risk it as you get more and more assets across that thing, and you're just putting small amounts across more funds.
Yeah, spreading that, spreading the assets around, the tenants around that. Ideally, again, no guarantees in life, of course, but not one tenant or one property is going to bring your portfolio down.
Exactly right, exactly right. And I must say as well, one thing that we did touch on was just about those numbers. I've had a lot of people that have said to me in these past programs, or even at the recent Momentum Wealth seminar, they were saying, I'm never going to get to $1 million. I'm never going to get to $2 million. Why do you talk about these huge numbers? But we're seeing here that you can actually have a 10-year goal in mind, buy these residential properties, build your wealth on that side, so that when you do come time to retire, you do have $2, $3, $4 million there ready to convert out of residential into commercial if you need. So if you've got $3 million at a 6% return, well, you've got $180,000 a year in income. You can do whatever you like.
Yeah, it's a good position to be in. And I guess, look, this client had a 10-year plan, and we were able to help them get some great resi properties that did perform particularly well. But of course, that is not always that's going to happen that quickly necessarily in a cycle. It was an upcycle in the particular locations that we bought in. But I guess it's just going back to clients. When do they start looking at commercial property? 10 years out, maybe that's not. Maybe they should be looking at it sooner. What do you think?
I think once they've got a good core balance of assets sitting within their portfolio, then that's when they should start looking, regardless of time. Obviously, the earlier the better. We have a lot of investors that have just started well and truly earlier. You got teachers and doctors and just your everyday people that have done extremely well, just because it's all about time in the market rather than time in the market.
Yeah, and I think that's an important thing for the the people listening, before you're getting into commercial property, which we think is a good idea generally to balance out a portfolio, you've got to make your own decisions, of course, going into funds, but start to get some education, understanding about it before you just jump straight in, because again, it's not risk-free, and even when you spread the risk around multiple funds, multiple assets, there is, look at the office market, for example, around Australia. That's been pretty tough investment. You might have lost some money there. So it's important to be understanding and educating yourself well before you start investing, isn't it?
Oh, definitely. In fact, quite a lot of the investors end up starting on the momentum wealth side, but they start looking at our funds from day dot. And they might be 2 years on our database. They might pick up the phone to our team and just ask questions and say, look, I'm not ready yet, but I want to understand how this works. We're all for that, because the more educated they become, the better they're going to be when they make that decision.
Brad, anything else you'd like to add? What else in that client's journey? Anything else that was unique or something that might be useful for our listeners to find out about their investment journey, and particularly through that Westbridge Fund side?
I think the important thing for them is they had a really clear long-term plan. Like, there's not enough people that come in saying, this is exactly where I want to get to at this point, and this is when I want to retire. There's people that come in, they look at an opportunity and they see a return and they go, great, I'm going to jump on it. But there's no plan around when they're going to finish it, when they're going to get that capital gains back. If you're going across multiple funds and you've got multiple residential assets and you've got other portfolio things that have got nothing to do with our side, just to get a balanced portfolio, you need to understand that they're going to finish on certain years. You finish them all in the same year, you're going to get absolutely hammered on capital gains. So the fact that these guys really were clear around what they wanted, how it balanced in with their overall portfolio, I thought it was very smart.
Brad, thanks for rounding out this episode. Appreciate your great insights and knowledge, and appreciate your time on the show.
Thanks for having me, as always.
While we brought different team members in to unpack the case study for a full-service agency, it's important to note that communication between all business units is always happening throughout the whole process. So the entire team is aware of where the client is and how they can use their expertise at any stage. Looking at the state of play at the moment and talking through this client's journey really reinforces that having a full-service agency on your side shouldn't be seen as a cost, but as leverage. Whether you're buying your first home, upgrading or investing, this episode reveals why property success is rarely about luck and almost always about having the right team from the start.